Welcome to the Mortgage Guy Podcast with your host, Darian Newlick, where I will educate you on mortgages and real estate done right. Hello, everyone. Welcome back to the Mortgage Guy Podcast. Very excited to be back with you all. Again, we're going through guidelines as of right now. Very excited to get into this. Before we jump in, I just want to actually give a shout out to my very first partner, Lululemon. So excited to partner with them. Currently, I am wearing a men's metal vent t-shirt. These are great for working out. They are fantastic at taking away your sweat and being cool through an entire workout. So go online to Lululemon and why don't you shop today for your next pair of workout clothes. All right, so let's jump in here. Today, we are going to go over FHA. So there is a lot with FHA. We have already gone over Fannie Mae and Freddie Mac as a recap. Fannie Mae and Freddie Mac are both the conventional insuring entities. So those are all for conventional loans. Now here's the FHA product where there's a lot of people that tend to fall into this bucket. A lot of it down payment assistance, or we just need to utilize for a higher debt to income ratio, whatever it may be. So a very common loan that is done. Don't be afraid that it says FHA, or when you hear that word, it's not a bad thing. A lot of people have FHA loans, and a lot of people move forward with purchasing a property or refinancing with an FHA loan. They do have some expanded guidelines above the standard conventional loans, and also areas of opportunity where you can, and most lenders will, manual underwrite a FHA loan where they don't for a conventional loan. So just to jump right into the guideline here, because as you know on the last two podcasts, quite a long period of time, but at the same time, I want to walk you through in these first podcasts that I am doing through these guidelines so that you understand from a mortgage perspective the basic and most common elements of qualifying for a loan, especially with today, the FHA. So first thing we're going to start at in the FHA Handbook. When you go search that up, you find the PDF. So here we're only going through Section 2, which as you can see here, Section 2, 112 through, if you scroll down here, sounds like a lot, people, but we're going to fly through it again. The common criteria that we see on a daily basis here as a mortgage loan officer. Anything outside of those is where you would have to come and ask me with specific questions. I'm trying to touch on as much as I can in the time that I have. So all the way down to 683. So we're going to go ahead and I'm going to scroll on down. So let's go on down here on the left side. You'll see I'm just scrolling on down. So we can start on page 112. Almost there. Here we go. So it looks like sometimes the pages are off a little bit here. So let me scroll on. I think it's actually 141 is on this little tab column, but page over there, you'll see it's going to be the right one. So here we go. 141. There we go. Perfect. So you'll see second part, origination through post-closing endorsement, blah, blah, blah. So 110, and then this kind of opens up. So it looks like actually like 111. So just starting through here, origination processing, a lot of this, this is a lot of entry level. This has nothing to do with you qualifying, appraisal validity, maximum age of mortgage documents. You'll see they may not be more than 120 days old at the disbursement date. So we can't get a pay stub that's from 4 months ago. So everything just predominantly needs to be current. Most underwriting is going to require an updated pay stub or updated documents, things like that. So just going on through here, handling of documents. These are pretty irrelevant to the qualifying aspects, so I'm going to pass through these. Going on down, electronic signatures. Again, most of everything's electronically signed. Don't need to worry about that. Just trying to get on down to application name requirements. So you want to make sure you put your full. So just a common thing is like making sure that you have the full legal name. So you want to make sure you're putting your full legal name on the application. A lot of people or loan officers will not put the full legal name, And ideally, you want it to match your driver's license. So you have a state issued ID that is matching your name that's being put on there. And ideally, again, you want to make sure that you have the full legal name for when you do run credit. For instance, if your name was, we'll say Zach Johnson, there's probably thousands of Zach Johnsons in the country. So if you have your middle name, it does help differentiate, and it also helps in the event of, let's say, another Zach Johnson lived in the same state and they had a tax lien, and it shows up in your public records because your name is Zach Johnson. Sometimes public records pick up accounts for other people, and you just need to prove that that is not your account. So a loan officer could easily go to the county website. Most documentation or court records are produced online, so you'd be able to go and print that proof or download it and upload it into the file to show that it was a different middle name. So it's good just to have that, just to save on time. Little thing with mortgage insurance with the FHA, just to touch on it here. This is not the actual part, but just to go over it with you. So a lot of people are afraid of mortgage insurance. They don't like it. It's extra money you're paying. Basically, it's insurance for the lender because it's risk-based insurance, but it's really set by the FHA, and the lender doesn't receive that money. It actually is for the FHA. And so the mortgage insurance is basically in place because it's a high-risk loan. So what it constitutes a high-risk loan is you're putting down, number one, less than 20%. So ideally, when you have a home and you foreclose or you default on that home, the lender has to resell the property, but they're not hiring a realtor to do that. What they're doing is they are actually sending it to, there's a lot of, I'm trying to think, there's auction companies where these auction companies will go ahead and facilitate a purchase. So you will go ahead, home goes into foreclosure, there's an actual bid or a sheriff sale that's done, and these auction companies handle that sheriff sale. And what they will do is once someone puts in a bid on that property, they go ahead and they sell it. Typically, it's going to be way less than what the loan was for, or at least a decent amount less. So if you're buying this property for less than what the mortgage is, at least they've recouped some from the mortgage insurance that you pay, which is very minimal as well. So a common reason why people will use FHA is because if you have a lower score, if you're in that 620 to 680 bucket, what's going to happen is you actually have a better mortgage insurance pricing than if you went FHA. There are exceptions to that. So like we talked about Home Ready and Home Possible, you do have some breaks there. So if you're 640 to 680 and you're doing Home Ready or Home Possible, you probably will have better mortgage insurance than FHA. But if you're not utilizing Home Ready or Home Possible specifically, and you're doing somewhere between 3 to 5% down, then ideally the FHA mortgage insurance will be better. Okay, so that's one reason why people do an FHA mortgage over sometimes a conventional. A lot of it, again, predicating on that credit score, how much you put down, the type of program. But again, that's essentially the gist of mortgage insurance. The other thing with FHA is you have an upfront insurance premium that's tacked onto the loan amount. So again, that's 1.75% for FHA. When we go on to the next two sets of guidelines, VA and USDA, they have their own sets. FHA's is 1.75. Again, that actually is tax deductible, and it's just risk-based insurance for the lender. Again, that actually goes to the FHA. And again, that is predominantly because it's a higher risk loan. The FHA will lend to people that conventional entities typically won't. But again, there's a lot of loopholes in the conventional guidelines. So as long as you're working with the right loan officer, you should be able to know what those loopholes are in order for you to be able to try to get around that, go conventional. If not, then you have this FHA option to fall back on. I will say if you're under 640, you're typically looking FHA. And the only reason if you would go conventional less than a 640 but above a 620, because conventional minimum is 620, then you would have to have less than typically a 28% debt to income ratio. Sometimes it could be a little bit higher. You have to have compensating factors. I like to see that we have at least 3 to 6 months of assets or mortgage payments in there inside of, assets. So like we could talk like investment accounts, retirement, 401ks, stocks, bonds, checking, savings, and then you are doing a 15 to 20 year term. That's generally where Fannie Mae or Freddie Mac would approve the loan at a 620 to 639. And they do say if you're at 28% or less, that the mortgage is deemed affordable. So that's the other compensating factor that generally will get the loan done. So 15, 20 years, you're doing a reduced term. Again, all these factors come into play, but if you have a co-borrower who also would go on the loan with you, you can generally go to a 30-year loan, things like that. So they use co-borrowers, non-occupant co-borrowers, whether living or not living in the property, as a compensating factor as well. You just got to make sure that they have better credit than what you have. Okay, just a cool little fact that you can do a rehab loan, not just with conventional entities, you can do it with FHA. Typically, you want to stay away from the FHA loan. If it is a renovation, we will get into that once we get into a renovation podcast for you at a later date. Borrower eligibility, general requirements. So you have to have a financial interest in the property. There are some exceptions. So you can be a non-occupant co-borrower and do an FHA loan. So if you have someone to co-sign who's not going to occupy the property, that's okay. So that's good news there. Age limits, 18 and over, minimum credit score. So just to give you a perspective on credit score with FHA. So this has been a big thing with COVID. So FHA has always had programs down to a 500. Okay, so eligible standard, you'll see right here. The borrower is not eligible for FHA loan is if the mortgage decision credit score. So the mortgage decision credit score, every lender in the country is required to use your middle score. There's no exception to any lender out there who's doing an FHA loan, conventional, any government-backed loan. Okay, so from a government-backed loan standpoint, it's your middle score, same for every lender. Is less than 500. So that means they'll do a 500 credit score. Here's the thing to keep in mind. So just to give you an update on COVID. So with COVID, the FHA, okay, they pulled back their minimum required credit scores to 680. They did that because of the standpoint of COVID, people losing jobs, the uncertainty, the craziness in the market. It was bad. And a lot of investors on the secondary side, so once a loan closes, what happens is there's two types. You can have a bank, which is going to service their own loans, and they will typically have more strict guidelines. A lot of them aren't doing 620 credit scores with the FHA. They're usually doing 640, 660, 680 because the money they have, it's backed by the FDIC, but they're essentially lending their own money, and they will have to hold that paper. So they're holding that mortgage. They're not selling it to a servicer. And so they need to ensure that this money that they have, which is their client base's money, it's a depository institution, is going to be protected. So ideally, they're going to have more strict qualifications because they want a lower risk of default. So you can have that side where they service the loan, or you can have the other side, which is where a lender will go ahead, close on your loan, and then they will sell it to a servicer who will go ahead purchase the loan for higher than what the lender lent. So let's say it's $30,000 higher, and they're going to service the loan, and their business model is the servicer's model's based upon you paying your interest payments over time, and that's how they make money. So someone's got to do it. That's why there's servicers in place. So when COVID came, the servicers or investors that we call them, when you do an FHA loan, they didn't want to buy loans under a 680. And so it became a point where it didn't make sense. And when people would say, hey, we'll buy it, but we're going to buy it for pennies on the dollar. So we're not even going to give you the full amount. It's not worth it for a lender or someone to service that mortgage, even a bank to do that. So they brought it back up. They brought it to a 680. Over time, they've let that score go down. They've opened it up. So a lot of lenders are at 620. Some lenders have gone down to a 600, and some have even gone down to a 580. I'm sure there might be one or two that have probably gone all the way down to 500. But the thing to consider is that so when a lender opens up a lower credit score bucket, so 600, 680, 620, 600, 580, 560, so on and so forth, 20 points. So when they opened up a lower tier bucket, it means that they're not getting enough volume currently. So they're evaluating that lending or that owner of that company, or sometimes it's a lender and they have a committee. They're reviewing their volume of loans that they have and seeing if they need to take on the risk of taking on a lower credit score client. And so ideally they will open that up when they need more loans. So basically they need to make some more money, so they open up this other tier of credit. So what happens is in the secondary market, if you try to sell a 540 credit score, FHA insures the loan, blah, 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 540 credit score, you will get significantly less money as a lender from the servicing entity buying that loan. It's very minimal profit. It is not a lot. So usually there's commitments from these servicers saying they will buy X number of deals, or before you even start underwriting those loans, there's some commitment to buy some of these deals so that they know it's at least worth it. They're going to get something, because it may be a difference of, we'll just call it, if it was a $200,000 loan, you might get, we'll just call it 15, 20 grand from the servicer on a 620 client, but you might get 5 on a 540. And so that's a significant difference, because a lender is set up as someone who's self-employed. They're running a business. So if you're running that business, you get 5 grand and you have to pay back $4,500 of that to processing, to pay your processor's payroll, your underwriter's payroll, your loan officer's payroll, expenses, like the percentage of expenses for each loan for what they have to allocate. It's not really that much money left over, and really it's not really profitable. So again, you have to really need to open up those buckets, which means you're typically a higher priced mortgage lender. You have higher rates, higher costs, things like that. So you need to supplement your income with opening up programs less than a 620. I don't like to classify people as credit scores. Keep that in mind. No loan officer ever should. But at the same time, just in order to explain this, just so you understand, I'm going off of those scores so you have a better understanding of it. So there's just some understanding there. So ideally, if you're going down to 600, the guidelines are generally similar to a 620. You go to 580, they get a little bit more strict. You're going to find your debt to income ratios are less than the standard 56.99 across the country. Typically, they're going to be less. And then the lower you go, the lower the debt to income goes down, the more strict the guidelines. So someone who would qualify as a 500 is someone who, like, for example, they pay their debt on time. They might have had some bad past experiences. Maybe they had a bankruptcy 2 years ago. They've paid their mortgage on time, never missed a payment on their mortgage ever. And they're putting down 5 to 10% on the property. Actually, I think it might be 15%. I haven't done a 500 in a really long time. But you have very strong compensating factors. Really, your score shouldn't be a 500, but with the credit bureau system, it looks like a 500. That's someone who's typically getting done. So like, I make 200 grand a year. I've got no debt. I have my mortgage, but I had some bad stuff in the past that has not given me the ability to season that up yet. I'm going to put down 15 to 20%, and will you offer me a loan? And someone will probably do that loan. So that's just a general example for you. All mortgages must be done in the United States. So there you go. These are FHA is only primary residence properties. So you can only do a mortgage if it is a primary resident. If it's your primary residence. You cannot do a second home with the FHA, although you can have an FHA second home. So what I mean by that is, let's say you live in Texas and you have an FHA mortgage. You get relocated to Pennsylvania for work. Well, you are allowed to take out a new FHA loan in that property in Pennsylvania because you need to move, you need to relocate. And FHA says that is acceptable. You just can't have more than 2 FHA loans. So you can get that other one and you can have your property in Texas as a second home. That would be the only way. You could also look at it as an investment property if you want to do that too. Essentially, once the loan closes, there's nothing to say that you can't make a property an investment property. So there's no guideline or anything that says we're going to come audit you and your mortgage after you've closed. U.S. citizenship's not required for mortgage eligibility. I would just say you would need to have your permanent resident card, your green card, all that good stuff, and that just needs to be reviewed. It just depends on the status. Green card, you're usually fine, but it's more of that permanent resident status or non-permanent resident status. You have your work authorization card. You need to get that in. Okay, so let's kind of zoom in a little bit faster here. Start to get more of the nitty-gritty. Period for delinquent on FHA mortgages. So if you're currently delinquent on any mortgage, you can't get a loan. You need to make sure that that's taken care of. Delinquent federal debt. So this is delinquent federal tax debt. Once you have at least 3 months of scheduled payments, so if you owe money to the IRS, you are allowed to go onto a payment plan. So this could be even for past years, and you need to pay 3 months. You cannot prepay. So you can't say, okay, IRS, I want to set up a payment plan with you. I'm going to pay all these. And then they say your payment is $200 a month. You can't go pay them $600 and say, okay, I'm 3 months. You have to wait until you make your first payment, you make your second payment, and then when you make your third payment in the 3rd month, that's when we can count that you've had 3 months of on-time payments. That's how that works. You can, if you want to prepay, that's okay. You still have to wait till the 3rd month. There's no fast forwarding that. Something else just to bring up on delinquent federal debt, just because we're on this topic. So there's a system called CAVERS. So CAVERS is with the government. And if you are delinquent or in default with any federal tax debt, it will get reported. They're required to report that to CAVERS. Predominantly, you're going to find that you're going to have student loans in CAVERS. I've personally never seen anything outside of student loans in CAVERS come up in default, but I'm sure there's other government entities that can do this as well. Again, student loans are the most common one. So if you're in default, and so in other words, you had a government student loan, it went to collections, you didn't pay it, and it, instead of filing a judgment, essentially what they do is it goes into default. And once it goes into default, they report it to CAVERS, and it may not show up on your credit report, but what's going to happen is you're going to need to, if it shows on CAVERS, you need to pay that. And you cannot set up a payment plan. You can't do anything with it. It's either got to be, it's got to be paid and cleared. There are some tricks to do, but it's not like a fix that gets you out of it immediately. So what I mean by that is you are able to go ahead, set up a payment plan that will be a preliminary payment plan term. You will pay that amount for 6 months, and then they will go ahead and say, okay, we'll remove this from CAVERS and bring you current because you have shown a track record over 6 months of paying them. But the problem is you can't be under contract and buying a home and do that. On a refinance, it's okay. You wait 6 months and then you go ahead and then you close on the refinance. But on a purchase, you're going to be kind of out of luck. You're going to back out of the contract. The seller's not going to keep the contract and wait 6 months for you to do that payment plan. So just kind of depends. I would just say double check if you are in default. You should know it's a situation where you haven't paid student loans that are federal based. And if they are federal based student loans and you know you haven't paid them, you should probably call them and see if you are in default with them before you do the FHA loan, or at least disclose it to the lender so that the lender can go ahead and it'll take them 2 minutes. They can go ahead and pull up the CAVERS, pop in your info, and see if it's reporting on there. Okay. It's a first lien mortgage, consent of non-borrowing spouses. So it just depends on the state. If the state requires that, it's different for every state. Tax liens, you need to make sure that it is resolved. So if you have a federal tax lien, again, you have to have that payment plan, So tax liens. My bad. So when you have, this means you have a lien against your property. That needs to be satisfied. So a physical lien against your property. So the federal government put some sort of lien on your property for some reason. So anything like that would need to be satisfied. That means you currently have a mortgage with a tax lien. That's not a good thing. To make regular payments. So it looks like a repayment. You can enter into a repayment agreement, my bad. Make regular payments on the debt and the borrower has been made timely payments for at least 3 months. Okay, so this does allow for that as well. So you can have 3 payments of those tax liens. Additional eligibility requirements, nonprofit organizations, that's not common. Eligibility, living trusts. I'm not going to get into that. There's not a lot of people that have their homes in a trust. Going on here, occupancy types, principal residence. It's going to only be principal residence. Again, that instance I told you about it being a secondary residence is allowed. That's for a particular situation. I would say just if you have an FHA mortgage, you'd want to reach out, let us know. If you want to get a second home and not sell that first one. This actually just gives you some information about that. So exceptions to the FHA policy limiting the number of mortgages per borrower. So relocation is a good reason. Here's some basic info on it. You can see I'm 176. You can go through all this, 145. But just to go over the exceptions, relocation, increase in family size. So I have had some people actually do this because of just simply the increase in family size. Your loan to value, the key one is your loan to value ratio on the current property that you have, saying that it's an FHA mortgage, has to be less than 75% or is paid down to that amount. So vacating a jointly owned property is another good one, and non-occupying co-borrower on an existing FHA mortgage. So if you were a non-occupying co-borrower on an FHA mortgage, but now you want to buy your primary residence, so you don't live in that property, you don't file it on your tax returns as a primary residence, it's nowhere indicated that you live at that property. You would just, again, we're a non-occupying co-borrower. You probably would have to show some sort of proof of that, maybe, and then ideally you can go ahead and buy your own primary residence. So that's another reason there. So just going to scroll on down here. So I know this says investment property. Investment property refers to a property that has not occupied the borrower. They're not eligible for FHA insurance, so you can't do an FHA loan. Property criteria. Ideally, I mean, so you're seeing flood hazard. Every loan's going to see if it's in a flood hazard or not. The one thing about flood hazard with FHA that it stinks. I wish they would change it. I think they might in the next 5 to 10 years. I would hope. But conventional loans allow you to have private mortgage or private flood insurance. So if you're in like Florida or something like that, you get some private flood insurance. Great, you're going to save a ton of money. You can get it for pretty cheap. But FHA requires that you have public flood insurance, or in other words, you're going to have to get it basically from FEMA. And so a lot of that, the problem is that it depends on where you live. It can be expensive. A lot of Florida, for whatever reason, like coastal areas, they tend to not be terrible. So I think FEMA and how they put together their flood insurance, I think there are some other companies you can go through for FHA, not just FEMA. But it's not terrible on the coastal lands. But when you go to the Midwest, so for instance, I'm in Indiana, and there's people out here who will be marked in a flood zone who have a creek in their backyard, not an ocean 1 mile away. Like in Florida, person in Florida is not marked in a flood zone. The person in Indiana is marked in a flood zone, and they need to get public flood insurance, and they're paying $3,000, $4,000, $5,000 a year for flood insurance. That throws people out of qualifying, all because a small little creek. It butts up enough to your property. Now, there are certain instances where if it's just outside or it's not on the actual physical structure of the home, in certain cases, the lender will be okay and not require you to get flood insurance. So it's a case-by-case basis. A great example would be I'm buying a townhome, and the townhome is in a community, and let's say all the townhomes back up to a little man-made retention pond. And so that pond, it looks all cool in the back. Yay, I'm on water. But really, if you look at the flood map, it shows a very tiny sliver of that butts up to the backyard. You're going to be fine. If this was like you had a full-on creek in the backyard, and the property line goes past that creek, or it goes to the end of that creek on the other side, you're probably going to need flood insurance. So it depends a lot of it on the boundary lines as well. So there's flood insurance for you. So that's just a good point to know. Seller must be owner, so that's fine. Property flipping. So this is actually a big issue that happens a lot. So property flipping is very bad when it comes to FHA. So property flipping is indicative of a practice whereby recently acquired property resold for a considerable profit, inflated value, subsequent resale, time restriction on transfers of title. The eligibility of a property for a mortgage insured by the FHA is determined by the time elapsed between the sale, between the date the seller has acquired title. So that's key. The date the seller has acquired title. That's not the day of closing. So let's take like Baltimore, Maryland into account. Baltimore is so slow on in their government on recording the actual new deeds from a sale. It might be 2 or 3 months after you have sold that property, or after you have purchased that property, that you are now recorded as the owner. So imagine that seller, if they bought the home 8 months ago, they went to resell it. Well, okay, so we have an 8-month period, but it took 3 months for Baltimore to go put them on the deed to the property and record it. Holy moly. Now we got an issue. So that just lets you know it depends on when that title shows with that county. There are some ways around it. If you show when the home was physically sold, you get the mortgage documentation, you track it down, but I wouldn't count on that. I really would go based off of the date that the county records it. The seller's date of acquisition. Okay, so we already know that. So restrictions on resales occurring 90 days or fewer after acquisition. A property that is being resold 90 days or fewer following the seller's date of acquisition is not eligible. Okay, so it is not eligible if it's not fewer than 90 days. It doesn't specify mortgage application. Date of acquisition is not eligible. I believe it is actually at the mortgage application though. Seller's date of acquisition refers to the date the seller acquired ownership of the property. To my understanding, it is at the application date. I would say base this on the application date. Don't base this on the closing date. Okay, so it's 90 days from the date. The date of the contract date. I want to say application. So ideally, the date of the contract. So if you put an offer on the property, it gets accepted. You have an agreed upon contract, and let's say that agreed upon contract is November 1st. It must be 90 days from November 1st. Okay. So in order for you to do it, resales occurring between 91 and 180 days after acquisition. So we're at day 91. The mortgagee must obtain a second appraisal. Okay, you need a second appraisal. The resale date of a property is between 91 and 180 days following the acquisition of the property. The resale price is 100% or more over the price paid by the seller to acquire the property. So if the resale price is 100% or more over the price paid by the seller, so let's say they're selling it for less, that means they're not probably flipping the property. They just need to dump it because they need to move because they're relocating. So that's a very key part to where if you need that second appraisal. So if they're selling it for more, which 9 times out of 10 they are, because they want to try to get more money out of it because they owe X amount of dollars, then you need to get a second appraisal. So 9 times out of 10, you're getting a second appraisal. If the second appraisal, so this is key because I actually had this happen. If the second appraisal supports a value of the property that is more than 5% lower than the value of the first appraisal, the lower value must be used. So let's say the home appraised for $100,000, and what's 5% of $100,000? $5,000. So let's say the appraisal came, the first appraisal came in at 100, the second appraisal came in at 95,000. You could still use 100,000. If they came back at 94,999 or less, then you have to use the $94,999 or less as the new value of the property. So it's 96.5% financing of the new appraised value, or whatever the amount you're putting down plus your closing costs. So 3.5%, 5%, 10%, whatever it may be. It's 10% of that lower value. So just keep that in mind. And then anything above that on the purchase contract, you either renegotiate it down or you go ahead and you bring that additional to close. Exceptions to the time restrictions on resale: properties acquired by an employer or relocation agency, resales by HUD under an REO program, sales by U.S. government agencies, single-family properties. U.S. government agencies of single-family properties. Getting a little too fast here. Sales of properties by nonprofits. So as you can see here, there's clearly no flipping being done. This is like a need. We need to sell this for a reason. So just reach out if you want more. Not even going over this part on hotel transient use. Mixed use of, so this is actually a good one. Mixed use of property, a minimum of 51% needs to be used for residential. Okay, so you need to have at least 51% of the property used for residential. How that's determined? An appraisal. So if the appraiser goes out there and he or she sees a sign that says John's Automotive, there's a big garage on the property, and you have that's probably larger than the square footage of the actual physical home, you're probably not buying that property FHA. If it's just a home, it looks like a home, you pull up and there's, you have a daycare in there. And really it's not a daycare, it's just kind of like, hey, I'm using my living room, I watch a couple kids and I get paid for it. Well, he's probably gonna mark that it's more than 51% used for residential. So kind of use that as your factor. I've had a lot of people who said, well, technically on my taxes, I mark it as this. But it's up to the appraiser to mark what they feel based on the overall property that you have. So I would say use some common sense there. Does your property look like it's for a business, or does it look like it's for residential? If it looks like it's for a business, you're not doing an FHA loan. If it looks like residential, then you are fine. Okay, so let's go down here. Property types: single family, 2 to 4 unit homes. You can do manufactured, townhomes, row homes, individual units within FHA approved condominium projects. They will not insure commercial, boarding, hotels, motels, if there's any other fraternity and sorority houses. So again, 1 unit, 2 unit, 3 to 4, you're fine. You can do 3.5% down for all of them. There are some requirements on additional dwelling units. Depends on the property, so I'm going to leave that one alone. There are ways that you can use rental income in certain instances. It just depends. So the pity payment principal interest taxes insurance divided by the monthly net self-sufficiency rental income may not exceed 100% for 3 to 4 unit properties. So like a great example is a 2 to 4 unit property. If you have rental income coming in from those properties, you're fine. You can actually count that income because you are renting them out. It's your primary residence, but the other units are used for living quarters. We know it's a 2 to 4 unit, so you're allowed to rent those out. Use that money. It just can't exceed the principal interest taxes and insurance part, not the mortgage insurance, but just the pity payment, not the pity me. So there you go. Additional dwelling units refers to a habitable living unit added to, created within, or detached from the primary 1 unit single family dwelling. Remains a 1 unit property. Single family residential property with an ADU remains a 1 unit property. For any property with 2 or more units, a separate additional dwelling unit must be considered as an additional unit. Ideally, they're okay. So again, it just depends. Here we have condominium units. So here's the key thing. A lot of people don't know this. A lot of loan officers do not know this. And I reciprocate, or what's it called? That's the wrong word. I get the privilege of being able to do a lot of loans that other loan officers can do, and they just don't know that they can do them. So a condo, okay, a lot of people think, they say no to condos because the FHA approved list is so small. You're talking like, you could probably count on two hands, how many approved condo complexes there are in the per state. It's very small and not worth looking into. So they have this other part. They're called site condos. So a lot of people don't realize this, but a site condo refers to a condo project that consists entirely of single-family detached dwellings that have no shared garages or any other attached building. Okay? Condominium project that consists of a single-family detached or horizontally attached townhouse. Okay? Does not contain any manufactured housing units and is encumbered by the declarations of condominium covenants or condominium form of ownership. So I shouldn't say most, a lot of condos are not on the FHA approved list, okay? But a lot of condos are actually this one, detached horizontally, so that means side by side, horizontally attached townhomes. And they do not contain any manufacturing housing units. And they consist of the dwelling and the land. So what does that mean? That means you have your townhome, or your attached townhome structure. It looks like if you were buying a home in a normal community, and you have a little bit of land, and you pay taxes on that land. And when you get the covenants and the bylaws for that condo complex, or that HOA company, it verifies that you own the property and you own the land. So that's a key thing. If you have an attached townhome, horizontally attached, not back and front, horizontally, you own the land, so you're going to look at the covenants and you're going to look at the tax bill and see if you are taxed on the land. There will be a land assessment. I'll say land is $17,000, land is $5,000, some tiny portion because you have like the smallest dinky little plot of land. But whatever that amount is, that assessment amount, you're going to probably be a site condo. And then all that you have to do is the mortgage loan officer needs to send that to the underwriting department. They need to send that to the FHA. Just run it by them. They get the A-OK, you're good, and you have a site condo. It's not that hard. It's just a little bit of legwork up front. Most places are like that though. If you have stacked condos, don't even try. Don't even worry about it. It looks like an apartment. That's not going to fly. It's never going to be on an FHA approved list. Don't even think like that's even okay for FHA. It's not going to work. So this one's big. Another one is up in Michigan. There's actually a lot of these detached dwellings. So essentially what they look like is they look like a regular house that's just simply detached. And for some reason, they're marking them as condos. I mean, it looks like a regular home. They're saying it's a condo. It's got an HOA. But again, for whatever reason, they're marking it as a condo. Again, it's big up in Michigan. But those are also site condos as well. So they don't fall in this condo issue. They actually are okay. You can go standard, regular FHA mortgage. Okay, manufactured housing. If you want a manufactured house, you can do it. They have programs for that. I just would veer away from that just because the manufactured homes, you need extra inspections. They could get quite pricey if you're buying an existing FHA. If you're buying an existing manufactured home and property. So if you want to know more about that, let me know. Again, it's not a common loan that's done. Property valuation, don't need to worry about that. Go down here. This is all that good. Mortgage brand, that's fine. There are maximum mortgage amounts. There's actually loan limits for each county of each state. You can go to Google, type in FHA loan limits, search by state, and you can look by county. What is your area? There are high cost areas, low cost areas, one or the other. Special exception areas, you can see that. Financing of upfront mortgage insurance, we already went over that, it's included. So it's going on down here. Loan to value limits, 96.5. You can get down payment assistance to go to 100 or 101.5. So 1.5% above the actual purchase price. You can go there. So it just depends on what you're looking to do. Again, you can put as much down as you want. If you put down 5% or more, your mortgage insurance is reduced to 0.8%. Another key thing about mortgage insurance that I forgot to mention. If you put down 5%, it's 0.8%, not 0.85%. And if you put down more than 10%, your mortgage insurance is on there for 11 years. And then if you put down just under 10% or less, then your mortgage insurance is on there for all 30. So a lot of people don't know that. They still think the old rule in 2013 when it got changed, they believe that once you get down to 80%, which actually was 78%, it falls off, and that's not the case. So you eventually have to refinance the property. Identity of interest, it's a sale between parties where there's an existing business relationship between family members. This is actually a little bit more common today. So it's 85%. You have to put down 15%. The maximum LTV percentage for a transaction where the tenant-landlord relationship exists, it's 85%. Exceptions would be a family member. If you look here, maybe exceed if the borrower purchases the principal residence of another family member, or the property owned by another family member in which the borrower has been a tenant for at least 6 months, immediately predating the sales contract. So it has to be the sales contract, not the closing date. So that's very, very key. So you can start the application, but make sure that the contract isn't in the system until you have 6 months. So builder employee repurchase. It may be exceeded if an employee of a builder who is not a family member purchases one of the builder's new houses or models as a principal residence. So that's another way you can get out of this tenant-landlord restriction. So let's go here. Corporate transfer may be exceeded. Tenant purchase may be exceeded if you've lived there at least 6 months. Evidence or other written evidence of verify the tenancy and occupancy is required. So this is key because I've had family members who have wanted to buy an family member's investment property. If it's the family member's investment property, this does not work. This falls under, or this goes to where you're a tenant and you've been there 6 months. So it's only if it's the other person's primary residence that you can do that. LTV limitations on non-occupying, non-occupying borrowers, you could still, maximum LTV is 75%. It could be increased to 96.5 if the borrowers are family members, provided the transaction does not involve a family member selling to a family member who will be a non-occupying co-borrower transaction on a 2 to 4 unit property. So it can't provide these. So a family member selling to a family member who will not be, so you have to be an occupying co-borrower, and it can't be on a 2 to 4 unit. Okay. If the borrowers are family members, yes, so they have to be family members. So otherwise, it's 75%. Ideally, you're going conventional at that point, but there's the rule. Refinance, you could do refinance transaction as well. They have special streamlined requirements that don't require an appraisal. You just bring 2 months of your payments to close, and that way it helps eat some of that cost because you can't really roll in anything into the mortgaged amount. It's just your balance, and then that's really it. So your costs are actually, you need to bring those to close. Most lenders take a little bit of a hit on that, so they reduce the amount on their own terms. But still, I just tell people it's about 2 months. This is more upfront insurance premium. Okay, let's kind of pick it up here. These are all just kind of, it depends on the properties. They're property-based questions around like encroachment, things like that. Lead paint, you can't have chipped or peeling paint. That just kind of, a lot of this depends. Well water testing, you need to get your well water tested. Shared well, so like these are very specific, non-common, so I'm not going to go over those. If you have any specific property questions, again, let me know. I'm not going over all of that. We would be here for days. Automated underwriting system. I mean, ideally, it's as long as you have the credit score, then you're fine. I mean, credit score and income, you're typically going to be approved. There's not really a whole lot that FHA won't approve. There's got to be something like seriously wrong with your credit. So here's one thing. So if you are requiring a downgrade to manual, so you have to do a manual underwrite, there's a list of criteria. There's actually a lot of people that fall into this. So like there's a lot of people out there who work with credit repair companies or things like that, where they throw a lot of disputes on your credit, whatever it may be. If you have a lot of derogatory accounts with disputes, it's going to be downgraded, and you have to go to the manual underwrite guidelines, which is 37 front end, 47 back end. There are also some additional that require even less on the loan to value. It just depends on your situation. But if you have any questions about that, let me know. There's, again, a lot of instances where people fall into this manual underwrite. A lot of it is based around information that can't be inputted into the automated underwriting system. So basically the lender's doing their due diligence. So that kind of is the information. Like a foreclosure is not going to report on your credit. Bankruptcy will, if it's within 2 years, yes, it will show on there. Those are the most common ones. Mortgage payment history, if for some reason the mortgage wasn't reporting because like you had a bankruptcy 2-3 years ago and you never reaffirmed it, there's no reason why you would, but let's say you had a late payment, that would cause it to be a manual downgrade. Undisclosed debt, public records, things like that could cause a manual downgrade. So quite a bit of information there. I would say just let the mortgage company assess that. A lot of loan officers are not in tune with that. So it is good if you do kind of go in knowing, hey, I have these issues going on. Can you see if this would require me to have a manual downgrade in this specific instance? If you're trying to do an FHA loan. Collections, charge-offs. So charge-offs means you don't owe the account. It does hurt your credit the longer it sits on there, but if you do qualify, you don't have to pay that account. A lot of companies tell you you do, and that's actually false. You don't have to. Judgments, things like that. Some of them, again, they do allow a payment plan. Some don't. Just review that. Inaccuracy of debt. If there is any inaccurate debt, let the loan officer know, and that way you can use that in an explanation, and then they would find proof and then ignore it. That does help. Scroll on down here. Clear documentation, liabilities. Again, you want to make sure you have on-time payment histories. There's some leeway as far as 1 to a couple lates here and there. Income is all predominantly very similar to, again, Fannie or Freddie. So this federal debt, so if you have any federal debt, IRS, things like that, then you have to count those payments like your payment plan, things like that with the IRS. Alimony, child support, separate maintenance. If you pay it, then you have to count it against you. If you receive it, then we can count it for you. Ideally, you want it to be court ordered. There are some exceptions if it's not court ordered. Calculation of monthly payment. So if you have garnished wages, you have to deduct that from your payment because technically, again, and we'll mark that as like child support is your garnishment. So child support, $200, whatever it be. Gotta get like a divorce decree, stuff like that. So anything of that nature, again, very specific, let the loan officer know that you're in that situation and what specific documentation do you need to obtain. Non-borrowing spouse, so refers to debts. So if you're a non-borrowing spouse, you're not typically disclosing your debt. So, I mean, in a community property state though, so I think like Wisconsin, Arizona, I think Arizona's one. There's a list you can Google community property states. You do need to actually get the debts of the non-borrowing spouse and actually include that in the debt to income ratio. Then you have deferred obligations. So deferred obligations, they just recently changed the student loan from 1% of the overall loan amount to 0.5%. That's really the only deferred obligation you're going to get. So student loans is the very next thing. Installment loans. So let's go to, there's this, where is it? Revolving charge accounts. Mortgage you must pay is shown. Account statement or 5% of the outstanding balance. So it's account statement or 5% if it's 0. 30-day accounts. Not worried about that. If you pay off the outstanding balance, I'm not even worried about that. We would just exclude it. It's not a big deal. Collection accounts. If you have a collection account, you need to pay it. Or if it's less than $2,000, then you can put in 5% of the amount. Where did that say? 5% of the outstanding balance. No documentation is required. So there you go. Charge-offs, you don't owe the money. There we go. I will say so obligations not considered debt. Does it say it on right here? I'm not seeing a time frame on here. So there's some debt that doesn't need to be considered if it is less than 10 months owed. It does depend on the amount in relation to your income. So if the amount owed is significantly, like it's a large sum, and it's going to be within 10 months, they won't let you exclude it. But there is a percentage of that. I don't know exactly what it is. I would have to look a little bit deeper in here for you. I'm kind of breezing by as much as I can to get through this because you see we're at 205. Employment-related income, W-2s, 2 years, pay stub, most recent pay stub. If you're hourly, you need to have, if you're variable income, so you're hourly, but you have your hours vary, you need 2 years. There are exceptions for 1 year and greater. So you need to review that with the loan officer. If you have at least 1 year, let the loan officer know, and they can take a look. It depends on your past history and things like that. Ideally, I would say I have at least 1 year and 6 months. And as long as you're at a year and 6 months, most lenders will approve that. Part-time income, 2 years. Again, if you're 1 year and 6 months, some lenders will consider that. There is enough lenders out there to confidently say that someone will do that or count that income. Overtime, bonus, tip income, that is all, again, same thing. As long as, actually, this one's a year or more on overtime, bonus, and tip. I would say as long as you have a year and it's likely to continue, I would throw out the tip income portion. But bonus and overtime in that form, you're good with 1 year as long as it's likely to continue. It just, again, it depends on the type of employment that you have. It's case by case. Seasonal, if you have seasonal jobs, they can be counted as an average over 2 years. That's a hard stop though at 2 years. Employment, housing, employed by a family-owned business. So there are some restrictions around being employed by a family-owned business. Obviously you can't, if you are the owner, you're filing, you're showing self-employed documentation. So you need to, the actual company needs to ensure that you're not an owner in the family-owned business. So that's very key. So we'd have to show tax returns. We'd have to probably reach out and get some additional information. Calculation of effective income. So also commission, I would say if you're a year and 6 months there, 1 year is a little bit more tough. It is doable. After 1 year, it just, again, that's a depend. And then self-employed, always 2 years of tax returns. That's a hard stop. You need 2 years of tax returns. Rental income, 2 years of tax returns. You can use lease agreement. It just depends. So you have to take a look at the rental income. You could actually use, so if you have 1 year, and then I have to count the year that you have for the rental income. If it's before a year, you can count a lease agreement. If it's greater than one year and you have 2 years of tax returns, then ideally you kind of want to utilize the lease agreement option, or you want to utilize the No, yeah, that's right. You either want to utilize the lease agreement option. I'm confusing myself. Or you want to utilize the 2 year. I would say don't utilize 1 year. If you only have 1 year of rental income, it's usually a loss or it's not very good. So I would say probably avoid that. And go down here, minimum length of self-employment, that you won't even get approved unless you have 2 years of tax returns. So that's typically a little bit over 2 years. So profit and loss statements, balance sheets. We need to get a decent amount of stuff for that, but usually it's not bad. It's actually pretty easy to for your income. You also get to include business use of home, so it just gives you a little bit of additional income. Key thing, write off. So when you write off miles, write off business miles. On page 2 of your Schedule C, make sure you write off business miles. If you have a car and you pay it through your business, actually report that on your business tax return. Schedule C, business, 1120s, whatever it may be. Report that you pay that through that business and pay it through your business account for 12 months, and I can exclude that from your debt. A lot of people don't realize that because they think, oh, it's my debt. So make sure you do that. It has to be 12 months. If it's before that, I can't count it. There's disability. There's other forms of income you can use: alimony, child support, separate maintenance. We're just going to actually get proof, divorce decrees, things like that, proof from the government. You can use adoption income, child support. A lot of areas of income. Auto allowance. First, the funds provided by the borrower's allowance must verify and document the automobile allowance from the employer for the previous 2 years. So it looks like you need a 2-year on auto allowance. I've never had to include auto allowance. It's either, because it's so minimal. So if you do get one, just know you have to have it 2 years from that current employer. Retirement income, that's usually tax returns and then proof from the retirement company of your agreement. Social Security award letters, bank statements, things like that. Pension, same thing. Rental income, already went over that. 1 unit, 2 unit, 4 unit. Just want to see if they have the income from commercial. So no income from commercial space can be included. So there you go. Ideally, you're not putting commercial space on your Schedule E. A lot of times, let's go down here. History of rental income. Previous tax filing, documentation existing, most recent tax returns. Properties with less than 2 years, the mortgagee must document the date of acquisition, providing the deed, closing disclosure, or similar legal document. Limited or no rental history, the monthly operating income reported on Fannie Mae forms. So there's a form that we have to create, and 75% of the fair market rent. So there's a rental analysis you have to get on that property. You'd have to order a separate appraisal for that rental property that you have, and then you take 75% of whatever the market analysis is that the appraiser comes up with for that market rent analysis, or the rent reflected in the lease agreement or other rental agreement. So in other words, if you're buying a 2 to 4 unit property, you'll get a rental analysis if there's a lease on that property or that rental agreement, and you can use 75% of that. So that's actually good to know. So scroll on down, 2 to 4 units, those are all fine. Borders, it's fine. Assets, just let us know what it is. We'll let you know what you need to get. Ideally, just figure most recent 2 months of statements. If it's like a retirement and you are getting quarterly statements, you just need one. That's predominant for those. Non-taxable income grossing up. So you can grow up non-taxable income like child support, Social Security. Some pensions don't have tax deductions, or they're already post-tax, so you're not getting deducted. You can gross it up. Just depends, and a lot of that. So you have to get your tax returns to show that it is not being taxed. Or if you don't file taxes, then you just write a letter saying I don't file taxes. Asset requirement, and the lender has to run a hit on the tax returns with the IRS, see if it comes back, and if there's a no hit, then you're good. So assets, there's assets. Don't need to go up anything like that. It would be nice if I saw gift funds. So gift funds, if I can find it here: cash on hand, retirement accounts, stocks, required private savings, gifts, personal, and equity. So personal gift refers to a contribution of cash or equity with no expectation of repayment. So this can come from a family member, employer, labor union, close friend, clearly defined and documented interest in the borrower. So you live together, something like that. Charitable organization, government agency. I think I said employer, yep. Government agency. So that's actually nice that they actually put a close friend with a clearly defined relationship. That actually is nice. I feel like that's a more recent change. But yeah, so if you like live with someone essentially, and they want to give you a gift, they're going to probably live in the home with you, or you can clearly define you as a friend. Then you're going to be able to get that approved for. They're allowed to give you a gift. Door source of funds, cash on hand is not acceptable. They have to you have to get a gift letter, and basically they need to wire it from their account to you. In order to count that, you have to show proof of the funds leaving their account going into your account for you to utilize that gift. Standards for equity, so that's fine. So equity, you're allowed to give as much equity as you want. Dated donor by borrower. Yeah, so you're allowed to give as much equity as you want. There's no restriction on that, and that goes towards the down payment. You can give them 20%, whatever you want. Again, if you're giving 20% equity of a home's value, you're not going FHA typically, but you can, because you try to want to avoid that mortgage insurance if possible. So there's that. Secondary financing, so you can get a down payment assistance loan. It covers the 3.5% or up to 5%. There's some for even less if you need that. Ideally, you don't want to do that. Family members can give you money for down payment that is allowed. Private individuals, organizations, I'm not even going to that. Loans, don't take out a loan to do the down payment. There's no lender out there who's going to really allow that. Grant, you can get a grant, so a grant works. There's a lot of aid programs within cities and that you can get. They offer grants, things like that. Employers, I'd say that's pretty much the most common. So let's keep going down. There's no sweat equity, anything, so I'm not even worried about that. All right, conditional approval. So that just is. So basically, now this takes me to like manual underwriting of the borrower. So just know if there's something that requires you to a manual underwrite. So if you have something in particular, the loan officer reviews your credit, you bring up certain instances and ask them, would this be a manual underwrite? Then we'll get into this. I'm not going to go over all the manual underwrite guidelines. It's going to take way too long. But basically, you have a reduced amount of 37 to 47 as far as debt to income ratio. Typically, I'm actually going to go find this here, and I'm going to pull that up. So this is all the same handbook or same sections. It's just a little bit more key differences. And so again, if you fall into manual underwrite, then we would explore whatever it may be, or I can answer any questions at that time, or a loan officer would be able to. You just would want to make sure to pose any potential issues up front. I can't stress that enough, and ask them if those issues would require you to be a manual underwrite. Can they get approval on that before they pre-approve you or anything like that? Like, make sure that they answer that question, because that drastically changes what you can do. So I'm just trying to find, there is a section on it. I thought it was an actual chart for you to see. There are some instances where you can go above the 3747. Again, you'll see that, I mean, a lot of this is honestly the same stuff. So it's basically saying like, hey, maybe you need some extra documentation, a longer history of stuff. You typically need reserves of 2 to 3 months if you're a manual underwrite, whereas you don't on a primary. Sources of funds are all the same, no difference. They're just restating all of that. So again, I'm not going to get into all that with you. But if I keep going, we should find the chart here. Again, all repeated. I mean, FHA is a great loan to do if you want to do a loan, and you know, I get it. You know, so we all want to avoid the mortgage insurance. Oh, here we go. But at the same time, if you're able to get into a loan and this helps you do that instead of renting, it's still a way better option than renting. You're building equity into a property, and just to know if your appraisal passes FHA, you're getting a good sound home. You're not going to have to put a lot of money into it. They're not passing homes that are going to have major issues or anything of that nature. So in other words, FHA has a little bit. All appraisers, even conventional loans, are looking at the lendability of the property, making sure basically it's not a renovation loan or a construction project. It's livable, you're fine. FHA has health and hazard issues as well. So from a health and hazard standpoint, is there anything that would affect you? And just kind of, if you were to walk through the property, is there anything health and hazard that you would see? And then there are like code violations and things like that the appraiser is also looking out for, like GCFI outlets are out to date. There's chipped and peeling lead paint all over the property, and there's no handrails that could pose an issue there. So here's so that's just a key thing to point out. So here's from a credit score standpoint with the manual underwrite, you'll see. So 500 to 579, it's 31 to 43. It's a manual underwrite if you're under essentially 620. You're in a manual underwrite. 580 and above, 3143. If there's no compensating factors, energy efficient homes may have stretch ratios. So I wouldn't even figure energy efficient homes. That no one's going to really abide by that. 580 above, one of the following: a verified and documented cash reserves. I would say have 3 months. Minimum increase in housing payments. So if your payment's not really increasing much, so minimal. So what is minimal? 1,000 to 1,100, 1,500 to probably 1,750. Like those are minimal. 1,000 to 2,000, that's double. That's not going to be minimal. And then you could pass the VA residual income test. So usually people have one of these. That's not hard to get. So 31, 37, 47, very easy. 580 and above, no discretionary debt. I would actually have to look at the definition of that. I'm not too sure. But this is the one that they're going to more or less use, 40 to 50. Two of the following: reserves, minimal housing payment, significant additional income not reflected in the effective income. So if you're only counting X income because you don't want to show the self-employed income that you get because you don't want to deal with all that. There's a lot of times where the loan officer doesn't include all the income because why get all the extra docs? We don't need them. You already qualify with flying colors on the income side, or you qualify with enough on the income side to get to here, the 40 to 50. Then ideally you can say like, hey, here's a tax return that shows I have more income. You can use that, and so they would use that residual income as well. So that's where I'm going to stop here. That's the majority of FHA. There's not really a lot more to go over. If you have any particulars that you want to review, just let me know. Again, you can always drop a comment. I would prefer a DM. It does help me a lot more to get alerted. So any questions about FHA mortgages, again, if you need to recap anything on Fannie or Freddie, let me know. I know it's a lot of info, and again, there's a lot of specifics that you could ask me that I will continue to keep that as a trend. I'm going over the basic, most common elements that we need to go over in order to help you here. So any other questions? The last thing I'll leave you with is bankruptcy. It is 2 years for Chapter 7. You can be in a bankruptcy. Ideally, you want to be at least out if it's a Chapter 13. Just be done with it. Don't try to get trustee approval. Foreclosure is 3 years. So you have 3 years on a foreclosure. Short sale, I believe, is also 3 years. So those are some extra little tidbits there that I can think of off the top of my head. And I believe that's it. Those are the main ones. So anything else that you can think of, drop me a DM, drop me a comment below. And that is FHA mortgages for you. So we've gone over Fannie, Freddie, and FHA. And next week, we will go over VA. So thank you for tuning in. I appreciate you very much, and I hope you have a wonderful day. Thank you for tuning in today to the Mortgage Guy Podcast. Make sure to follow me wherever you listen to your podcast on iTunes, Spotify, or my YouTube channel. You can follow me as well on all social media platforms.